and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance, ESG. This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode of ESG Talks, Andrea Torres Villanueva, an associate on KBRA's ESG team, interviews Eric Thompson, Senior Managing Director and Global Head of Structured Finance Ratings. Eric and Andrea discuss ESG trends in securitization, the challenges of ESG integration, and KBRA's process of incorporating ESG considerations into structured finance transactions.
So, hi everyone, it's Andrea Torres Villanueva from the ESG group at KBRA. Welcome, Eric, and thanks for joining me today to talk a little bit more about the intersection of ESG and securitization, and also to talk about how KBRA integrates ESG issues into structured finance transactions. So with that, Eric, I'm just going to dive right into the questions. So the structured finance sector has characteristics that distinguish it from other asset classes, such as corporates or financial institutions. So what are some of the challenges to incorporating ESG considerations in securitization credit risk analysis?
Well, thanks, Andrea. Happy to speak today on this topic. I'd say one of the more meaningful differences is that corporates and banks, which are effectively living institutions, dynamically manage ESG over an indefinite time horizon. In structured finance, securitized vehicles generally have a finite term over which they are expected to be outstanding. And as such, they have little, if any, ability to influence the ESG characteristics that are associated with loans or other collateral that was originated prior to securitization through the term of a transaction. Furthermore, while numerous ESG considerations may be associated with structured finance assets, such considerations may not result in a meaningful, quantifiable increase in the default and loss of rated debt issued by the securitization during its term, which is fundamental to our ratings analysis. And I realize that was a dense mouthful, but there are some other challenges surrounding structured finance and ESG, one of which is the depth and breadth of asset classes in the structured finance market, and that ESG factors that may be considered by asset class will vary based on the type of collateral that's being securitized. This compounds issues that are already present surrounding ESG data availability and consistency. But fortunately, major trade groups in our industry, including the Structured Finance Association and CREFC, have established working groups to focus on ESG issues.
Thanks, Eric. So how do you think about ESG in the context of structured finance?
Well, despite the aforementioned challenges, ESG has always been integral to structured finance transactions. I'm just not sure folks think of it that way because the ESG factors that intersect structured finance don't always neatly translate into quantifiable default risk. I started working in structured finance in CMBS in the 90s, so it's easiest for me to start there. And if I go back to that time, which was quite a while ago, it was always ordinary and customary to review third-party environmental reports, and where issues existed, have upfront reserves or other mitigants. And if there were no mitigants, the asset may never be eligible for securitization. And that hasn't changed. Furthermore, dating back to that time, insurance was required for natural disasters such as windstorm and flood, as well as for real estate located in active seismic zones. And the insurance that's required, it needed to be sufficient to restore a property. And again, those requirements generally haven't changed. However, meaningful but broader questions such as whether an asset will be impacted by rising sea levels in the decades to come or in 100 years, the issue there is it isn't necessarily relevant, for example, a lower Manhattan asset that secures a loan with a 10-year term, as those considerations won't necessarily increase. In fact, they won't increase the risk of default and loss over the term of the securitization. What's more relevant is the insurance the building has in place for flood peril, at least at this moment in time. Residential mortgage-backed securities can also be subject to environmental issues, but most residential mortgage loans require hazard insurance, and geographic concentration risk is always considered in our analysis by either increasing or decreasing our expected losses for a subject pool in accordance with our rating methodology. And I guess I'll touch on ABS as well, but our rating approach there implicitly takes into account expanded affordability products that, importantly, help serve societal, social needs by facilitating access to credit for consumers that may have difficulty procuring a loan. And we do so by relying on historical performance data in determining our base case loss assumptions. And such products generally have higher losses for subprime products.
Yeah, those were really good examples, Eric. So how does KBRA incorporate ESG factors into its rating analysis and reports?
So as I mentioned, it's challenging to draw a direct connection from a specific ESG factor into a default probability, and frankly, even loss over the term of a given transaction. Nonetheless, KBRA will often highlight ESG factors in an ESG consideration section of new issue rating reports and, where appropriate, identify ESG factors which contribute to a rating change in its surveillance process. The ESG consideration section was in response to investor demand to convey both general information about an asset class and, wherever possible, items that are specific to a transaction. I spoke a bit about environmental factors in CMBS, and the ESG consideration sections will also try to point out if LEED or BREEAM certified buildings are present in a securitization, and more recently on a social front, rental affordability in agency multifamily pools. For MBS, we try to highlight wherever an issuer may be using the proceeds of a securitization for a social bond framework to promote housing affordability. And in the ESG consideration sections, convey general attributes about loans with non-prime attributes that help provide for expanded credit access, which comes at the cost of greater risk. And our methodology will typically produce higher losses for such loans than prime loans. For ABS, we rate a wide array of asset classes. And as I mentioned previously, for some consumer sectors like subprime auto, the underlying loans provide credit to an underserved demographic. And for autos, that's really critical in many areas of the country where having a car is a prerequisite to getting to and from one's place of employment. And at the same time, such loans do produce higher losses, which is reflected in the assumptions we use to rate deals in the sector, which is a function of the issuer's static pool loss data. We generally point this out in the social and governance factors portions of our ESG consideration sections. And where feasible, we also strive to put forth information that is asset class specific. For example, for the ESG considerations of railcar presales, we'll typically highlight that railcar is considered one of the more environmentally friendly modes of freight transportation, as railroads are 3 to 4 times more fuel efficient than trucks. And that means moving freight by rail instead of truck lowers greenhouse gas emissions by up to 75% on average. Our presales also highlight where issuers are using securitization proceeds as part of a green financing framework.
What else would you like to share to our listeners?
Well, as with everything we do here at KBRA, we welcome ideas and suggestions on what the marketplace would like to see from us, whether in our transaction reports, research, or other services. Such ideas led to a recent ABS research piece mapping the Environmental Protection Agency's greenhouse gas scores to the make, model, and year of vehicles in auto loan ABS, which was used to calculate average scores for various issuers. In response to calls for more transparency around ESG factors surrounding CMBS collateral, our KCP CMBS subscription platform will begin phasing in additional ESG content for its entire coverage universe as early as this fall, which includes both KBRA rated and non-rated deals.
Thank you, Eric. This has been very interesting, and I appreciate you joining us today.
Well, my pleasure, Andrea. It's an important, evolving topic that we'll continue to explore.
Thank you to Andrea and Eric for a very interesting discussion. Please email esg@kbra.com with any questions or comments. We also encourage you to visit KBRA's ESG website at esg.kbra.com, where you can find the details of KBRA's ESG approach, our ESG research podcasts, and other ESG-related media items. You can also join our mailing list to access our ESG weekly roundup newsletter. This concludes our episode. New episodes of ESG Talks air every other week. In the meantime, please visit kbra.com to access our other podcast series as well as our ratings and research.